All right, guys, hope you had a great weekend and an end to a crazy week last week as well. Looking like another crazy week up ahead. We're seeing a bunch of names that are moving on Wall Street Bets and this huge controversy between hedge funds and Wall Street Bets and GameStop. We'll start off looking at some of the crypto names like Riot, Mara, and MicroStrategy. So Bitcoin tapped above 40K recently, and right now you're going to see probably a nice big pop on Riot. Looking at the chart here, you see it's in a pretty steep uptrend over here. Obviously, I think it's going to be pushing around 30-ish in the next couple of days, possibly even tomorrow. So looking at the options chain on Riot, and again, it might be kind of late to act on it given that it's run up this weekend. But one sec, where's the option chain? Here it is. So Riot, you can see that for a month out or 3 weeks out or so. I wouldn't go with the weeklies just because it's pretty binary in nature, but if you want to trade the weeklies, you can. Keep in mind, again, as always, guys, IB is higher than HV, which means you got to use spreads. So looking at the week out, if you want to trade upside on Riot, and same thing can be applied to Mara and also MSTR. Obviously, MSTR only has monthly expiration, so that's kind of a limiting factor there. But you have the long call spread, 25-30, for example, right? And as you can see, you're risking about 58 cents or so to make a maximum profit of 5 minus 58. So $4.42, right? Now, obviously, if it pops tomorrow to like 25 at open, this is no longer actionable because it'll be much more expensive to get into that. But if you want to apply the same strategy, you just go more out of the money if you wanted to, right? So for example, you might go like 28-32 or something like that, or maybe even 30-35, right? Same kind of asymmetry of risk. Assuming it keeps on running, then you'd get paid out. But again, it would be riskier given that it's likely going to gap up tomorrow morning, right? So keep an eye on that. I know a few of you are selling cash secured puts, which is probably the better way to play it because there's a lot of premium to be had. For example, I know someone was selling a boatload of the 15 strike cash secured puts on Friday. So I think they actually accounted for most of this volume right here on the Friday on Friday's close. But you can see right here, you're getting about $1.50 of premium on risk of 15 minus $1.50, so 13.50 risk. So you're pretty much getting a return of 150 over 13.5, so 11.11% in like 3 weeks, right? Not too shabby at all. Or you own Riot at 13.50, right? So pretty simple idea, straightforward over there. Same can be applied to Mara. Obviously, the chart is very similar to Riot. Same idea if you wanted to play Mara. I mean, look at the same spread. It's pretty much the same asymmetry of risk, roughly, right? Maybe a bit more expensive in this case. So again, over here, you'd be risking about 85 cents maximum risk for maximum profit of 4.15, right? So asymmetry risk pretty good, but if it gaps up, it's not very actionable for tomorrow. But keep it in mind if you want to trade it going forward. Like, if, for example, you want to trade the following week out and it's at 28 bucks, look out of the money. And if you can trade the 30.35, for example, that's not too shabby because right now the 30.35 is trading for midpoint of around 60 cents or so. So you're risking 60 cents to make about 4.40 max profit, right?
And
yeah.
You did see that Bitcoin did drop $2,000 on at the futures today, right?
Yeah.
Okay, because you said a big pop up. I would think that those would be affected on the downside, wouldn't they? If Bitcoin dropped that far.
Bitcoin is still up overall, though, right? It's been running pretty hard the past week or so.
Back at 32,007.
Yeah. So yeah, but still, if it pops up to say 35K again or something like that, because it tapped 40K, right?
Yeah.
So if it pops up to like 35K, for example, right, you're going to see a pop in Mara, in Riot, and also in MSTR. MSTR is the only one that's kind of inactionable because, again, you have only monthly OPEX over here, right? So you can only trade monthly OPEX, and liquidity is terrible as well. So very wide spreads. So MSTR is not as actionable, right? But that's the crypto discussion right there. We're going to move on to the more important discussion of the week, which is all these volatility names that we've been discussing and seeing on Reddit the past little while. And we're going to start off with a name that I like a lot, which is Blackberry. So Blackberry actually has fundamentals behind it as to why it should go up, right? They have a lot of patents. they're going to be a very central player in autonomous driving going forward for both the OS and security as well. And they do have a lot of viability to their business because it is a software business, right? So I see a lot of upside in BlackBerry longer term. Obviously, it's popped a fair bit from 750 or so a few weeks ago to a high of 29 or so last week, closing down at 14 or so. So week over week, it actually closed flat. Here's the 1 year weekly chart. You can see it actually closed flat on the week, right? So previous week, it closed at 1404. This week closed at 1410. That right there was a pretty nice pin because it caused all the out of the money options to expire worthless. And that held the stock price right over here, right? But a limiting factor there was the inability for a lot of traders to trade BlackBerry on Thursday and part of Friday as well, right? On certain platforms. Among obviously AMC, Nokia, Gamestop, EXPR. I think that was the bulk of the names. There may have been a few more that I'm missing, but part of the reason why that was done on certain brokerages, especially Robinhood, was because they required more liquidity to trade those names because the margin requirements rose for people that were trading those names. And because Robinhood had so many people trading GameStop, for example, they actually needed more liquidity. And obviously banks are going to be hesitant to lend them money because why would, for example, JP Morgan lend Robinhood money when they're a competitor, right? So a lot of people are saying that, it was because, Citadel and Melvin wanted them to stop trading on those stocks so they could short it again and get it back down. I don't really buy that. That's very, very illegal, obviously. But from what I've read and what I've been told, it seems like they had a liquidity issue with people holding too many stocks in the margin names like AMC, GME, Nokia, BlackBerry, and margin requirements were raised, which is why they had to stop trading in those names, right? So obviously, I think that Robinhood is a pretty terrible platform, and if you're on it, I would get off it right away because I could see them actually going under. Which would mean that you'd have a lot of trouble having to get your money back. Obviously, if you're FDIC insured to the maximum limit of 250K, you should be okay. But keep in mind, it'll be a headache that you don't want to deal with, right? So keep that in mind as well. But for BlackBerry, again, back to the topic at hand. So BlackBerry closed pretty much flat week over week. Nice big wick above us right here. The IV is still pretty high. So if I pull up the options chain, you can see the IV over here. So the IV, one sec. So you can see the IV is 309%. HV is 214%. If I pull up the actually the IV chart, you can see how crazy these IV ramps are, right? So I'll pull up the IV chart for you guys to look at, just to depict how insane the premiums are right now. So you can see for the past, this is for the past 1 year period, right? So for BlackBerry, trading on the March contracts, for example, which is available since July of last year, traded around 50% IV for most of the year. It spiked up to about 100% back in December on that initial pop up. So BlackBerry actually had a nice big pop in December initially, came back down again. But you can see just how high the IV is right now, right? If you're buying options right now, you're paying a stupid high premium, and your probability of profit is much, much lower than it would be otherwise if you were to have bought back when IV was down over here, right? So you want to be selling premium when IV is super high, obviously in safe ways, not naked, right? So I'm not saying to sell naked calls, it's the worst thing you can possibly do. But for example, if you own equity in BlackBerry or Nokia or AMC, or I guess if you own GameStop, right? Selling covered calls, you're pulling in a lot of premium, right? Like, let's say, for example, you bought GameStop at 20 bucks a share, right? Right now, the at the money covered calls are I believe they're $128 per contract. So that right there gives you a guaranteed return of 600%. Plus, if you're assigned, you're still making whatever extra percent that you make on your money based on your entry price, right? So that would be a not so bad play, assuming that you want to get rid of your GME stock, which a lot of people want to hang on to because they think that's going to keep going higher and higher. But again, these names are going to be very volatile. BlackBerry, Nokia, AMC, GME, even Virgin Galactic because it's heavily shorted as well, right? But back to BlackBerry's options chain, which is right over here. One sec. Where am I? I just lost my chart. One sec. here we go. Okay, so for Blackberry,
Hey,
right?
Nick,
Yeah. Yeah. Hello?
are cash secured puts a good play?
On Blackberry, yeah.
Cash secured puts
Yeah, they are a good play.
on Blackberry?
Yeah, they are a good play for sure, right? So let's go over the expected move for the week
Okay.
on Blackberry anyway. Right now, looking at it, sorry, one sec. Just gonna miss some of these charts over here. So Blackberry's expected move right now for the week ahead is 34.2%. So upside is 19 roughly, downside is 930. The potential move is 47.2%. So the upside move would be $20.76 and downside would be 744, right? Keep in mind they have earnings in a couple of weeks, but as Shane just asked, if you wanted to use your collateral in your account to sell cash secured puts, it's not a terrible idea because of the high IV right now. So for example, let's say you want to own Blackberry stock at $10 a share come February 19th. You can sell a cash secured put for $1.75 right now, effectively owning the stock at 10 minus 175. You're going to own it at $8.25 a share, which is near the price it was at prior to it popping up, right? So if you're bullish on the longer term, it's not a terrible idea. Either you're going to pull in 175 in 3 weeks in premium, if it stays above 10 bucks, or you're going to own the stock at $8.25 per share, right? Not too shabby. And then obviously once you're assigned, you can then sell covered calls if you want and wheel it and pull in a lot of premium, right? If the IV stays elevated for, for 6 weeks or a couple months, right? You can scrape out a lot of premium and even potentially cover your initial investment and remove all your risk, right? So for example, way out of the money call options right now, like even the 40 strikes for Friday last week, here's a chart for the 40 strike. Sorry, this is February 2nd, right? But you can see the chart for the 40 strike from last week, right? Here it is. Let me just pull it up. This is the 1 week line. So you can see how crazy it got last week, right? So we actually had it spike up. And keep in mind, these are fresh contracts because the spike price in Blackberry caused the Option Clearing Corporation to release new contracts at higher strike prices, right? Because it was trading at 28 bucks a share. So look at this. Last week, these are trading at $9 per contract. Whoever bought on this heavy volume right here, someone bought heavy volume contracts. They actually bought contracts at $9 per contract, 40 strike a week out. Now just think about that for a sec, right? Your break even in 5 days is 40 plus 9. So just to break even on the trade, it has to go to 49 bucks, right? In order to double your money, it has to go to 58 bucks, right? So you see where I'm getting at right here, where if you're buying when premiums are super high, your probability of profit is very, very low, especially if you're buying way out of the money. So look now, you can see that the same contracts are 35 cents right now. So whoever bought these contracts lost their shirt. Whoever sold these contracts made a fortune in a very short time span, because you can see that right after they were sold for $9, they never traded higher than that. And basically they're trading at, below $1 for the duration of the past 2 days, right? And unless Blackberry spikes up above, 49 in the next 3 weeks, this person that bought, or whoever bought these contracts, will lose that money, right? This is why it's so important to analyze the implied volatility prior to any trade you make with options. Options are very dangerous, right? They can be the best creator of wealth, but also the worst destroyer of wealth as well, right? So in the wrong hands, they can destroy your account. In the right hands, they can make you very wealthy, right? The bottom line is, if you're going to gamble with options, not knowing what you're doing, you're going to lose a lot of money very fast. I've seen people lose fortunes very fast. Like over the years, I've seen many, many people lose fortunes. And part of the problem right now with the current market environment is you're seeing a lot of people, which is kind of confirmation bias, on Reddit, where you're seeing people post their crazy gains. Oh, I'm 15 years old, I made 200K in a week, in a month or whatever. Grandpa said I wouldn't do that, whatever. The problem is, it's not a repeatable process. You can't have a strategy around this one trade on GameStop, right? After it's over, how are you going to trade? Most people don't understand risk management. They're going to keep on trading the same asset over and over again. And eventually, using the same mentality that got them all that money, they're going to lose all their money as well, right? That's why it's important to understand what you're doing, why you're doing it, when you're doing it, and how you're doing it, what strategies to use when and why as well, right? So back to Blackberry again, right? So I'm bullish on it. Here's the option chain. And looking out a couple of weeks here, If you don't own the equity itself, you have to look at using spreads for upside trading. I do like the equity right now because, again, if you buy the equity at 14 bucks a share, let's say, for example, you want to buy 200 shares, right? Instead of buying 200 right now, you buy 100 for 14 bucks a share. You sell a covered call for example, 3 weeks out, right? At the money, or even if you want to go out of the money, you can go out of the money too, right? You can sell the 20 strike is going for right now about $3. So already your cost basis is 14 less 3, it's 31. I mean, 11, sorry, 11, right? And then on top of that, if you want to grab a second lot of 100 shares, instead of buying a second lot of 100 shares, sell one cash secured put at 10 bucks. You're pulling in 175. Now your cost basis goes down to a break-even point of 825 on this contract over here. So if you're selling the covered call over here, right, you're pulling in the 20 strike over here, right? You're pulling in that, plus you're pulling in 10 over here as well. So you're pulling in about 470 in premium. You're buying at 14 bucks. Effectively, you're going to own 200 shares at around $9.30, right? So not too shabby overall, right? I mean, it's not a bad strategy because, again, you're going to own the stock not too far from where it was before it popped up. And if you're bullish on it longer term, once you're assigned on 200 shares, then you sell out of money covered calls every month. And if you're pulling in, $2-3 bucks every month on high IV, you're pulling in a return of like 30% roughly every month. And you're shaving your risk down gradually, right? So you're shaving down from for example, 920 or so down to like 620, down to like 520, right? Over time, you pay off your shares, then you buy 100 more, for example. That's how you add to your position without increasing your risk overall, right? So that's Blackberry right there. Obviously, for the week ahead, if you want to trade it for the week ahead, looking at the premiums, they're still very rich. But that being said, if you wanted to trade it, you could trade call spreads if you're bullish in the short term. For example, you can do a 10 wide call spread for $1.40 roughly, right, for Friday. Break even.
Hey, Nick,
yeah.
Can I interrupt for a second? I apologize.
Go for it. Yeah.
Be,
Go for it.
Be careful with your brokers, okay? So what the brokers are doing right now, Webull, Robinhood, Thinkorswim especially, right? To some extent, some of the other ones, if you're Canadian, well, there's so much crap you get as being Canadians, you get to do whatever you want. But the US brokerage houses, they are limiting complex orders on options on all of these high flyer names of BB, AMC, NOK. Well, Naked doesn't have options. Ross is another one. And what they're doing is, if you want to sell a covered call, they will tell you to call in. Well, good luck, 2 hours. On the other hand, if you're trying to roll a call, for example, that's considered a complex trade, so you can't place it. A simple adjustment that's done thousands of times by a lot of people, including me, you cannot do. If you want to sell a spread, it's a complex option because at any given time, the short leg can be taken away from you for any reason, right? So therefore, they're not allowing you to do it. And also, if you are trading a spread, and if anybody knows, I trade spreads all day long, okay? I was nervous as hell on Friday at close, not because of the spread, but because of the risk that I have if the price fluctuates greatly on GME. And what I mean by this is, I had sold a call spread. I had sold 160, 165. If hypothetically, if it had actually happened and the stock closed at 155, well, fantastic, right? Because it's out of the money. I get to collect all my premium. Until Saturday morning, I realized that the price jumped up after hours, right? So 4 o'clock, stock is at 155. It's below my 160, 165 call spread that I sold. Or even if you bought it, right? Even if it's a debit, there's still a negative side to it. So I thought the options expired worthless. What happens is you can exercise an option all the way till 4:30, and in some cases 5 o'clock, but 4:30 for sure. So right after the market closes, let's say the stock just jumps $100, and you've seen it in GME. It moves $100 a candle. So now the stock is 266. Well, if I'm the guy who just lost his money on that 165 option, That's the 160 option. That's the naked option, right? Well, I can call my broker and say, exercise it. And at the same moment that I'm exercising that, because now I get to keep the stock at 160 and I got to put out 16 grand, I can at the same time tell my broker, as soon as you confirm that, sell even $3 underneath what the market price is, right? Because you want an instant fill. And now you instantaneously make $8,000-9,000. And the person who thought, hey, great, you know what? My thing expired. I'm so happy. I got me some money. Wakes up at Saturday morning, and they will not know till Saturday morning because the transaction books overnight. And Saturday morning, they're going to say, oh, wow, I got an extra $16,000 in my bank account. Where the hell did that come from? Well, that came from the guy who paid you $16,000 for the 160 call, right? And you are now negative 100 shares. You can't exercise your protection leg because it's expired at 4:30, right? After hours, if you knew, you would have exercised, but you don't even know. Now you're naked on something like GME, and you will have to be nervous until 4 a.m. Monday morning, because that's the earliest you can try to, kill it,
Okay,
buy it back.
I got some insight here, Hashish.
Mm-hmm.
So last Wednesday, I had the 115 calls, right? And me and Nick kind of had discussed this the night prior. I was kind of pretty ecstatic. I only had 2 calls on the 115. Those are free calls I was writing. And we discussed it. And I probably should have been up about 25K per call.
Yep.
The options chain opens up in the morning. I'm only up.
They slammed you.
I'm only
They
up.
slammed you.
Yeah, I'm only up 15K per call. Gamma is slammed. IV is flat. Gamma was like at 4 cents. So they crushed Gamma, and they flattened the whole options chain across the board. So I lost out on like $10,000 to $20,000 on 2 contracts, just because of the options chains being flat. And it was not because of an IV crush. I mean, I'm sure Nick could probably elaborate a little further on this, but it was something I had never seen before. How can you see a contract move up 100, or how can you see a stock move up $100 and all you have is intrinsic value?
Well, I'll tell you what it is, right? What happened was because of the manipulation, right, of the houses, right? So
Yes.
they limited who can open a transaction. You can't open a transaction. You can only close a transaction. So then what the market makers did was they don't have any new risk because you can't open anything, right?
Mm-hmm.
If you can't open a transaction, there's no risk, right? So there's no premium. Okay. So it becomes eccentric. Not only that, market makers, all right, everybody, they're not the bad people. Okay. Market makers are not the bad people. They're the ones who add liquidity so that you can get in and out. Well, it's moving so fast that they open up the bids. Okay. That in itself doesn't allow you a fair price, because they're taking off the top at least a few dollars, right? And these contracts aren't cheap. So those spreads that they're taking, you could lose $500, right? I know you're saying 20 grand, but you could absolutely lose $500 right off the bat, just closing it if you got a fill. But when there's no options trading,
they were cheap.
well, there's no risk. There's no risk to the upside. So at that given juncture, because the options chain is a fluid and live mechanism, correct? So it changes by the second. At that very second, when you were closing out, the option chain was limited to almost all the brokers, right, to only closing transactions. You couldn't go in and open a covered call, a spread, roll it. You couldn't do any of those transactions. The only transaction you could do is close. So they collapsed the premium to just the difference, where it should be the difference plus some time value, right?
Well,
Some
yeah.
IV value.
It was almost only delta. Gamma was
Yeah.
almost negligible.
Because there's no transactions. So the reason why there's a premium, right, is because somebody's going to sell an option and they're paid for their time. There's no selling options. It's only closing transactions. So if it's only closing transactions, market makers get smart. There's no time value. Close it, right? They're being smart about it. They're taking the extra money and it's evaporated out of the contract. Now, watch what happened. Eventually, the chain opened up and eventually things got back to normal. And you saw a little bit of the time value come back. You didn't see much. And the reason why is nobody wants to really sell these options. People want to buy them, but nobody wants to sell them. There's no value in it. There's no value in these next week of it. That's my take on it. Again, I'll defer to Nick as the expert.
Oh, that was a valid point because, I mean, just for future reference for anybody listening, like if you look at the GME contracts on the options chain, especially short-term expirations, like they're negligible, especially for the theta and gamma and everything else. It's like all you have on those are intrinsic values, basically.
Yeah, actually, so if you notice, actually, the theta is super high because right now the theta, for example, at the money, we close at 312 on Friday. The at the money contracts, this theta right here of minus 9.611. That means that every single day you hold these contracts until expiration. So for 5 days, they'll lose about $10 per day of premium just on time decay alone. You got to factor in Vega as well. So we dropped volatility on GME on Friday by 11 points. It's still super high at 541.8. If I pull up the chart on GameStop's IV, let me just find the chart one sec. You guys can see how insane it is. One sec. Where's the?
While you're pulling that up,
Yeah.
You're not asking the right question, right? Why is the option chain showing this, right? The more intelligent, savvy investor understands why. And don't get me wrong, I didn't get it. Somebody told me it, and then I understood it, right? It's because they don't want you to sell these calls. They don't want you to sell the puts. And if you're not selling calls and you're not selling puts, well then, and the market makers aren't doing it, then you cannot trade the instrument. If you can't trade the instrument, what will eventually happen? It will flatline and go back down. You'll have a move like the move you had in Tilray from nothing to 300 and back down to nothing, right? The market dynamics are, as long as there is a supply and demand, it works. If there's a demand and you can't get it, eventually demand fizzles out. For people to buy calls, somebody has to sell them. If you take the incentive out of selling them to just pure incentric, I'm not selling it as a person, right? Aaron might not sell it, right?
But
Somebody else might sell it.
It's eccentric.
Sorry. I'm sorry.
You mean intrinsic, guys? Intrinsic.
Listen, I'm having a scotch while I'm watching this.
I'm having a red wine.
I'm having water, guys. Yeah, to get back to the conversation, because obviously we don't want us to be like a 2-hour convo. You can see the April contracts for GameStop, just how high the implied volatility is right now. It's at 420% or so. It's kind of ironic, 420, right? That's a whole meme on Wall Street Bets. The IV was shot up to 420.7, so almost 0.69 right there, right? But you can see that over the past year, basically, it's been trading in a range of like 150 on the upside to a low range of around like 80 or so, or 75. So this spike right here makes it untenable for people to buy call options, because think about it. If you're buying a call option that expires on Friday, let me just change screens one sec. So
yeah,
that's the option chain.
600 to 1,000% IV.
Yeah. So the thing is like, if you're buying a contract for Friday, for example, let's say you want to buy call options on GameStop because you want to trade the upside, and you're thinking that you're fighting the good fight against the hedge funds, which in my opinion is kind of nonsense, but whatever. regardless, looking at buying the at-the-money contracts, you're putting up like $12,000 or so, or 12 and a half grand. And so you need to move up on GameStop of almost 50% just to break even on the week, just to break even, not to make a profit, just to break even, right? And if it pulls back at all, or if IV pulls back at all, you're going to lose your shirt in like 3 or 4 days, basically, right? But so what happens in the market is when implied volatility elevates, and this is what happened back in March, right? When volatility elevates to a certain point, these volatility arbitrage funds, they start actually selling volatility because they say it can't stay this high, right? It's akin to an insurance company saying, okay, now we're pulling in $5,000 a month for someone to insure their Honda Civic, for example, right? Well, obviously the insurer is going to be happy to sell that, but who's going to buy that insurance? No one, because it'd be cheaper to just buy a car every month, basically, if you want to buy a new car every month, right? Same idea with implied volatility. You know, at a certain point, people will stop buying contracts. That's why you're seeing way less volume on these contracts. You're seeing more volume on the even numbers, but again, you're paying a ton of premium here, right? And these expire in 5 days. If GME's trades below 300 come Friday, everything here expires worthless. Everything here expires with value. But at the same time, even if you buy put options, let's say you buy, for example, the 300 put option, and you're bearish on GME, right? And you paid $106 for the contract. You needed to drop $106 just to break even. So if it went down to $200, you're still losing $6 per contract, right?
Yeah, I lost $2,000 on Friday like that, just so you know.
Yeah. So my advice to you guys, right? And again, this is financial advice because I don't care, because it's risk management 101. Don't trade stupid contracts. Like manage your risk well, and don't buy when IV is stupid high, because that is how you lose money, right? Pretty straightforward. But looking at GME, right? Again, for the week ahead, and Frankie did the expected moves for the week ahead. I appreciate that very much, Frank, as always. Everyone thank him as well, because he does a lot of good work on that. So the upside move on GME this week is expected to be 573.40, and the potential move is as high as 647.53, right? So it has a potential to move 100% almost to the upside. Downside is $2.47, right? So just keep in mind that GameStop is still a pretty crappy company. At the end of the day, regardless of what people think they're doing, with some kind of movement investing in GameStop, at the end of the day, it's your money in your account. And if you lose 5 grand, 10 grand, 20 grand, 50 grand, 100 grand, whatever, that money is gone, right? That's your money gone, right? It doesn't matter. The hedge funds, they don't care, because Gabe Plotkin, for example, he'll open a new fund if his fund blows up. He'll get some money, raise some money, open a new fund next week. It doesn't matter to these guys, right? They're so wealthy beyond belief. Them losing $1 billion or a few $1 billion, it hurts temporarily, sure. They'll come back right away. A small guy losing 5K of his life savings, they won't come back, right? Totally different. So keep that in mind, right? Don't gamble. I would advise, if you're not in GME already, I would say just watch the fund and learn from this, because this is a once in, perhaps every decade or so, or every couple of decades event, maybe once in a lifetime event, perhaps, right? The last time this happened was with Volkswagen in 08, right? The infinity squeeze on Gamma on Volkswagen. I actually thought of a funny thing as to how the hedge funds could actually get out of this whole mess if they wanted to. And I doubt anyone's gonna actually listen to this video aside from a few of my buddies that manage funds. But the funny thing they could do, if they really wanted to, was say, hey, you know what? We're gonna put in an offer to buy out GameStop for $100 a share, because then the board of directors would have a fiduciary duty to consider selling the company at $100 a share, because the valuation would be far too rich for shareholders to pass up. That would cause everyone to sell off down to $100. They make their money on the shorts and probably buy the company for a boatload more than they should buy it for. It'd be a stupid transaction, obviously. Like, it would make no sense whatsoever from a logical standpoint. But that would be a way for them to unwind their shorts if they wanted to in that respect, right?
Couldn't they vote that down, Nick? They
could have voted down, but for the board of directors, they have a fiduciary duty to their shareholders to do what's in the best interest of the shareholders, and knowing that the true valuation of the corporation based on the revenues, based on their balance sheet, is far lower than $100 per share, they'd have to say yes, probably, right? Because if they were to say no, for example, and stock price trades at $20, in 2 weeks, they could be in a lot of trouble, right? That'd be the issue. So just some creative ideas right there that are kind of fun to think about. Obviously, they won't happen. I doubt anyone's going to buy GameStop for $100 a share. I'm just talking out loud for fun here for you guys to kind of think about. But besides that, I wouldn't really touch GameStop if you're not already in it. you know, guys, you know, it's your money, you know, manage it very, very well, because capital is hard to raise. And as the saying goes, right, once you have money, it's easy to make money, but getting that money first is hard, right? So if you have a little bit of money and you're trying to grow your account gradually, don't try and gamble on GameStop to blow up your account and go for a home run overnight, because keep in mind, you're buying at 300 bucks a share. The downside here is worse than the upside, in my opinion, right? If you're buying at $2 or $4 a share, you know, like Michael Burry bought, for example, then by all means, you know, over there, the asymmetry risk is phenomenal. You're risking $4 to make whatever, 300 bucks a share, right? But now you're risking 300 bucks to make what, you know, 100 bucks, 50 bucks, 20 bucks, who knows, right? So just manage your risk well, and think about how you would feel if you lost whatever money you put into a play like this, because overnight you could lose all your money pretty damn fast, right? That's why I was mentioning Blackberry as a longer term trade, because Blackberry, you know, it's seen some volatility the past few weeks, but it has credence as to why it's a long-term hold, right? They have a viable business that in the long run could do very, very well with autonomous driving, right?
To reiterate your point, Nick,
yeah,
do not buy contracts on GME unless you're buying deep in the money calls or puts or equities. Do not buy out of the money. That is ridiculous.
Yeah, it really is. I mean, you can see the IV for Friday is 727%, right? So it's pretty ridiculous to see, right? You're almost never ever going to see an IV this high in your lifetimes ever again, right? Like even for biotechs, for example, right? It'll be very rare to see a vol handle like 727 over here, right? But the next one I want to discuss was, let me just see one sec. Sorry, after GME, I had, sorry, one second, let me just minimize this. And okay, yeah, so I want to discuss Nokia as well, because Nokia had a crazy week last week too. So here's NOK. Here's the chart, right?
That's a good comparison too, Nick, with GMA to NOK with the float.
Yeah. Oh yeah, for sure, right? So just so you guys know, right? So part of the reason why GameStop is squeezing so hard is because if you look at the number of shares outstanding, this number right over here, right? Shares outstanding, right? And the shares floating, right? You can see that there are only about 50 million shares float right now, and 65 million outstanding. So to short a stock like this with low liquidity is kind of dangerous versus looking, for example, at Nokia, right? You can see they have 5.36 and 5.61 billion shares floating and outstanding, respectively, right? So looking at these stocks, they're very different stocks, because again, the short float here is only 1.11%, so not very high overall. Whereas looking at GameStop again, you can see over here it's 122%, right? So people thinking that you're going to see Nokia squeeze, for example, it's not going to happen, because there's no short squeeze happening with Nokia right now. Like the short float is so low right now, and the number of shares outstanding are enormous. And you're not going to see a squeeze like that. Even with BlackBerry, for example, you can see again here, right? You have 555 million shares floating and 562 million outstanding. Short interest a bit higher over here, a little bit higher, right? So again, you could see a minor squeeze to the upside, but again, you have more float over here, so the squeeze potential is mitigated. AMC, same idea, right? Over here, you have a small number of shares so very comparable to GameStop, because you have less shares overall outstanding, right, and floating, and you have a higher short float over here. So you could see a massive squeeze on AMC, for example. But again, keep in mind that you're investing in a corporation on the thesis that it will short squeeze the upside. You shouldn't be investing on it in it thinking that it's a good business longer term, because as we've seen during the pandemic, movie theaters have made pretty much no revenue whatsoever in the last year or so, right? So keep that in mind when you're putting your money to work. Do you want to be trading in assets based on a thesis of short squeeze, or do you want to be buying it on fundamentals, right? So again, back to Nokia. Here's a chart over here. I mentioned it last week. I posted a video last week too. You can see that we had actually the highest volume in the last 10 years on Nokia. So you can see this spike right here. Over 2 billion shares traded on Thursday, right? Or Thursday or Wednesday, I think it was Thursday. You can see massive spike, 10-year high, or sorry, almost a 10-year high. The previous high was 1175 back on February 7th, but it actually spiked above this level right here, 938, It almost touched $10 at some point during coming out of one of the halts. But again, Nokia has some interesting tech behind them as well, and they are a revenue generating business, so they do have viability behind them, right? Again, a very large float, so share price could stay low for a long time. It's a cheap share price. Selling cash secure puts on it is not a bad idea, because if you want to own it at around $4, for example, right? If the IV spikes again, you can sell covered calls, obviously, and that's not a bad idea. Is buying the stock, selling covered calls, even at 7 strike or 6 strike or 8 strike, whatever. If you can get some decent premium on IV spikes, at open, for example, on a gap up, why not take advantage of the uninformed investors that are buying these options out of the money, and pretty much buying them blind. Like I know some people that were buying the $10 strike price call options. I'll show you the chart actually on Nokia call options for, one sec, let me just pull the chart. Here it is. So Nokia, I'm gonna switch away from GameStop.
Insane.
So you can see that the call options for Friday, $10 strike price call options. Here's how nuts they are, right? So 1 week chart line, right? Check this out. They spiked up to $3 on, I guess on a Wednesday, right? It wasn't Thursday, it was Wednesday, right? So $3 on Wednesday. They're at 15 cents on Friday. If you bought these contracts, think about that again. You're buying the $10 strike price call option, expires in 1 week. You're paying $3 for that. The current price of the stock at the time when it was over here is around $9. So you needed the stock price to jump $4 more just to break even on the trade. And it's already up, from $5 to like $9, right? Keep that in mind. And again, it doesn't have the catalyst to short squeeze because it's not a heavily shorted stock and it has a massive amount of float. So trading this on a short thesis, a short squeeze thesis, is not a great idea. It's a terrible idea, actually, right? If you want to buy the company on the long-term feasibility of 5G or even 1T, for example, which is the next iteration after 5G, it'll be terabyte speed internet, right? That would be an interesting thesis, right? But buying it on the basis of a short squeeze, it doesn't make sense. AMC, different story, right? So AMC, for example, I don't like AMC again, right? Actually, you know what? I want to look at the option chain first.
And one other point, Nick,
yep.
is with the 5G data stuff that's actually going up for auction for the FAA right now.
Yeah.
Like they're buying the contracts right now. It is not put out to the public yet, and mainstream 5G will not hit until at least 2023.
Yeah, that's very fair. And Nokia is involved heavily in that stuff, and they're also heavily going to be heavily involved in apparently in space as well, because they'll be involved in launching satellites as well. So I mean, not launching them, but providing the technology on those actual satellites, right? So keep that in mind as well. But again, looking at the chain for the week ahead, the IV died down pretty hard after it popped up to I think it was like 320 or so on Wednesday. So it's been cut in half in the span of like 2.5 days or so. But looking at the week ahead, cash secure puts not very rich overall. If you want to collect $15 or 15 cents per contract on 385 risk, by all means, your return on investment is 0.15 divided by 3.85. You're making like 3.8% in 5 days. Not too bad, right? If you don't mind owning the stock at 385, not a terrible idea. Again, the covered calls a bit more expensive out of the money, so about 40 cents. If you see a spike up on IV and also spike up in price, right, on heavy volume again, you may see the prices inflate on the out of the money contracts. And I actually love that, because I'm long some stock right now, and I want to be selling premium every week or so, right? But looking longer term again, not much IV on out of the money contracts. You can get, for example, like $10 strike price 3 weeks out, you're getting 27 cents or so. It's not crazy, but again, if you're a slow and steady investor and you want to pull in that 2.7% in the span of like 3 weeks, that's not a bad trade at all, right? Like if you're buying the stock right here, for example, let's say you're buying at actually 460, for example, right? So if you're pulling in 0.27 divided by risk of 460 less 2.27, it'd be 433. You're actually pulling in a return of 6.24% in 3 weeks, and that would assume that you're okay with buying the stock at the current price, selling the covered call, 10 strike for 3 weeks out, right? And again, if you were assigned on the covered call and lost the stock at $10, you're pretty much making 150% return in like 3 weeks, right? That's phenomenal. So can't complain about that whatsoever. Looking at AMC though, instead, where's my chart on AMC? I had it over here. Oh yeah, here it is. Okay, so again, you can see over here, guys. Here's the 1-year chart on AMC. So pre-pandemic, if you go to the 5-year chart, you can see it was trading at 37.50. So it has the potential longer term to get back up there, assuming that the economy reopens as it was before COVID, and people are going to movie theaters again. The problem that I see though is that humans are creatures of habit, and right now we've been locked in our houses basically for the past year or so. We're watching movies on Netflix and HBO Max and whatever else you're watching on, Peacock or whatever these new platforms are. And these production companies have actually said they're going to be releasing most of these movies now direct to streaming platforms as well. So if you're a family of 4, for example, and you can either go to the theater and watch Mulan, from Disney Plus or from Disney, and pay like $60 or $80 plus popcorn and drinks, maybe $100 for a family of 4, or you can stay at home and pay $30 or $40 for the movie to stream on your platform and have it there to watch whenever you want to watch it, and have your own food and your own booze and whatnot. A lot of people are going to want to stay home, right? So you may not see the same numbers that we saw prior to the pandemic in ticket sales, right? So that could be an issue as well. And again, brick and mortar businesses are going to be hard to come back from, especially if COVID sticks around for more than a few more years, right? Who knows how long it'll last, right? But again, back to AMC. So AMC for the week ahead. Let me just chart over here so I don't lose it. 1 second, let me close this chart on Nokia. So for the week ahead on AMC, we have an expected move of 72.4%. Upside is 23 roughly. Downside is $3.66. Upside for the potential move is 26.50. Downside is like 2 cents, right? So I don't expect it's in 2 cents, but downside again could be down to $3 or so a share. But given that high short interest, which I mentioned earlier, you could see it push up pretty hard, pretty fast. Again, if enough people do buy it, because again, the short or the float on AMC is about 100 million shares. It's much lower than, for example, Nokia, right? It's about 1/50th what Nokia has. So if you're long AMC at these lower prices, hoping for a squeeze, you may actually get a massive squeeze, right? So looking at the option chain over here again, I don't advocate anyone to trade AMC because again, it's super risky, and I prefer slow and steady. But again, you can see over here, IV 531% for the week, 587%, historical is 446, right? And you're looking at for the week ahead, if you're trading upside, you're buying at the money calls, you're paying like 480 or so, right? So just do the math on that. You're paying 480 for an out the money call, or an out of the money call right here. Like you're out of the money by about 50 cents, right? So just do the math on that. You're paying basically 4.8 divided by 13.5, right? You're paying 36% of the stock price in an out of the money call option. Just think about that. So just to break even on the trade, AMC has to rise by 36% in the next 5 days, just to break even, right? If you want it to create a profit for you, and unless they want to double your money, for example, again, options are all about asymmetry of risk, right? So you want to be risking, for example, $1 to make $2 or $3 or $4. Not you don't want to be risking $4 to make 10 cents. That's terrible asymmetry of risk, right? It's kind of like if university costs $10 million, would you go to university or college? No, because the risk would be $10 million to make what? When you finish, are you gonna make $10 million? No, you're making whatever, 50 grand, 80 grand, depending on where you're working, right? Terrible asymmetry risk. Same idea with, yep.
So AMC is a great example, in my opinion, of selling covered calls. So
yeah,
you have a good position on that.
The only issue with that is that, again, look at the chart, right? So AMC was trading at like $2 and change just last week or 2 weeks ago, pretty much, right? Mm-hmm. So the downside is still $2, right? The downside is still $2, right? So let's say conservatively, the downside is the high, the previous high of the last, let's say the last the 1 year chart, right? So last 1 year chart. Let's say downside is the previous high or the past year, so like 750 area support, right? Even if you're buying it right now at like 1350 and you're selling the covered calls out of the money for, let's say, $4 and change, your break even is still above this price right here. So if it drops below this and IV gets shot down, and you're gonna have a tough time selling covered calls out of the money to recoup that. If you bought it, 250, right, a few weeks ago, which I know some of you guys did, including Rick, right? I mean, Rick bought like the very bottom, right? But if you bought down there and you're selling covered calls, then yeah, I mean, amazing, awesome idea, because you're pulling in like 200% return every week, which is phenomenal, right? But if you're buying at $13 or $14 a share, and you're selling for $4, and it drops down to like $5 again, you're still down $5 per share, right? And if the IV dies down and it doesn't pop back up to like $10 again, basically you're stuck holding the stock and bag holding it, which is why I actually I made that joke last week of Blackberry, AMC, and GME being the new FANG, which is BAG, bag, right? Because we had a lot of bag holders, right? Yeah, so again, unless you're comfortable holding the stock, long term, and I mean like 1 to 5 years out, because it may take a while for it to get back up there. The one thing that AMC did, which is very smart, was they actually managed to retire some debt on the basis of the stock price shooting up, which is an amazing move by management, right? It's a phenomenal move by management. So that was a great move. That may actually create a floor around 750 perhaps. So again, do you want to own AMC, which is a movie theater company, or do you want to own something more that has a more robust business, like for example, like a Blackberry perhaps, which has again better asymmetry of risk, because again they're selling software for autonomous vehicles, and if they get contracts with every vendor perhaps globally, for example, they'll have a monopoly on OS and vehicles and security as well, right? So that would be absolutely enormous, right? So we went over AMC, went over Blackberry, went over Nokia, went over GME as well. Next up on the list, let me just make sure I don't miss anyone's tickers. Oh yeah, so Virgin Galactic, right? So Spce, I've been mentioning for the past few weeks, and I actually mentioned in the first week of the year that this was my top pick for best asymmetrical risk bet of the year, because the asymmetry of risk is so phenomenal. You could see it pop 2, 3, 4, 5 times easily from the value it was trading at a few weeks ago, around 20, back around here, right? So 24 or so. And so I mentioned that once we see it break above that 35 mark, which is a previous high over here roughly, it has a clear path to all-time highs over at 42, 49-ish. If it breaks above that, you're going to see it squeeze higher, because again, it's very heavily shorted, right? So looking at Spce, they have a short interest right now of 27.45%. They have a float of 140 million shares. So you have another possibility of short squeeze over here. And again, because it's a newer business, it's hard to really quantify the value of it, because they don't generate a revenue right now. It's hard to really ascertain what it's actually worth, right? But so looking at the expected move for the week ahead on Virgin Galactic, we can see that it is so Spce, where is it? Here it is. So the expected move is 19.2% in other direction. Upside is 53, downside is 36. And then the potential move is upside 56, downside 32.43, right? So again, massive spike last week. I think that it's a great long-term play because of the asymmetry of risk. So buying the equity and hanging on to it and selling covered calls is not a bad idea. Buying in the money call options, a year out, for example, also not a bad idea. But again, manage your risk, because it is very volatile. You can see that in the last 3 weeks or so, it shot up over 100% at their highs near 60, right? So it is still very high. And understand that if the market does pull back, you could see this name pull back down to perhaps, I'd say probably around 35-ish, when maybe be the new floor area around over here, right? So previous highs will now become support, and that might be where you want to go long instead of buying right around 44. So if it tapped the lower move this week around 36, not a terrible idea, assuming you don't mind owning the company, right? If you've done your homework, you like it, then by all means, right? But manage your risk, do your own research. Don't take what I say, as gospel. I am wrong pretty often as well, right? Keep that in mind. So do your own homework, right? But looking at the option chain on Virgin Galactic, we can see over here. 1 second, let me pull it up. Here it is. So for this week, if you want to trade short-term expiration, very pricey contracts. Again, buying at the money, you're paying $4. The straddle cost is like $9, right? So pretty fat premium to pay. But that being said, again, given that the IV is elevated right here at 183%, You want to trade spreads if you want to trade upside. So let's say that you're bullish on it out of the money. You could go, for example, with 50 and then short the 60 perhaps, right? That might not be a terrible play. Again, assuming you don't mind a binary outcome, right? Because binary in that you could lose your entire investment pretty fast because it's 1 week out. I don't like trading short-term expirations, right? But I'm kind of sharing ideas here so you guys can trade them if you want to trade them. Obviously, it's up to you. But understand that trading 5 days out, you can lose all your money pretty fast, right? Out of the money. So with that being said, the asymmetry risk here, you're risking about $1.20 to make a maximum profit of $8.80. So phenomenal asymmetry of risk. Probability of profit not as high. It has the potential to get there. You know, the upper move is 54 or so, right? So it has a possibility of actually going to 54 or so. And if it does so, on risk of 120, you're making pretty much 280 return. You're making over 2 times your money pretty much, right? On the week. Obviously, downside, same idea could be applied if you did, for example, the 40-30 put spread, right? If you bought the 40 and sold the, maybe not the 30 because there's no premium here at all, but maybe the 35 perhaps, right? So here you're risking $1.40 to make, a maximum profit of $3.60. I'm not as big a fan of that. I prefer maybe instead, again, if you want to own it at 35, sell cash secured puts at 35 a week out. But you're pulling in $80, $85. Not a lot of premium, but it could be, easy money as long as you don't mind owning the stock at 35 less 85, which is 34.15, right? So not a bad idea. But if you're trading it longer term, as I said before, if you're buying leaps on it, like, a year out, you could buy leaps in the money. Instead of buying the stock right now at $44 a share, for example, you could buy the in the money call options at the 20 strike for, let's say, $28. So you're paying $28, your break even's 48, right? Instead of paying $44 per share, you're paying basically, $28. So you're paying pretty much about 2/3 the cost for almost the same position in the stock itself, right? And then if you went and you bought that and you sold a call spread out of the money. So if you did a calendar call spread, for example, selling above your break even, so your break even is 48. If you were to sell, for example, let's say the 60 strike for 3 weeks out, now your break even drops down to $24. So now you're paying the exact current price of the stock, but you're paying half the actual cost, right? Because you're paying $24 debit instead of paying $44 for the stock itself. And now your position break even is 44. So you're pretty much mimicking the position by just buying the January call option 20 strike and selling the February 19th 60 strike here, right? And then again, if it stays below $60, you keep your premium over here, and then you can sell more premium above your break even of 44 for the next year if you want, right? If it goes to $60, keep in mind your break even is 44. You're making $16 profit on risk of 24. So you're making a return of 67% return in 3 weeks, right? Obviously, keep in mind, you need to be okay with owning the stock at the break-even price in order to do this trade, right? If you're not okay owning it, then don't do the trade, right? Obviously, and again, manage your risk. I don't need to say it again and again, but I will anyway. Keep your risk in check. Don't bet the farm on any one play because all it takes is one bad bet if you go too heavy to blow up your portfolio, and then you're out of the game pretty much for a while, right? So keep that in mind too. That's Virgin Galactic. Next up, we're going to talk about, one sec. So we have Palantir now as well, right? So Palantir has been pretty volatile of late. Here's Palantir, last 3 months. So again, I mentioned previously that it was in this range right here, and it finally broke up. Now it's creating a new range, and you might see the lower end right around here, perhaps. I think you're actually going to see the lower end right around 28 or 30 area. So maybe around here would be the downside, and the upside will be again around like maybe 45. Maybe even 40, it'll stay in that range again. Same kind of pattern, maybe it may play out that we saw on a spike up to 3350 back in November, where it had a nice big upshoot over here, 45. And now you may see it consolidate for a period of time between 30 and 40 for the next perhaps 3 months or so, right? Before it resumes its uptrend to 50 or 60, for example, right?
Nick, sorry to interrupt you. There's if I'm not mistaken, this week or next week they have a earnings report.
Mm-hmm. They do, yes, absolutely. A great point, Shaheen. Yeah, so they report earnings. Palantir, they report on around February 12th week. I don't have the exact date right here, but they're expecting to move this week right now on Palantir. 12.3% in other direction. Upside 39.51, downside 30.85, and then you have a potential move of 16.9%. Upside 41.12, downside 29.24. Keep in mind, if the market does sell off hard, which, again, I mentioned last week, I expected it to go down to around 350-ish by March expiration date, and already we've dropped 4.5% in the span of about 3 days. If we do see a continued sell off down to like around 350 area on SPY, you will see Palantir probably go down to around 28, 25 bucks a share, maybe even a little bit lower than that. So there will be better entries to be had. But at the same time, it is trading in a new range likely here. And you're probably going to want to, assuming that you want to go long it, for example, like one person was asking me how to go long it because they lost their shares above 40 last week. They sold their stock and they want to buy back in. So I said, well, why don't you look at, for example, if you're doing Palantir, right? Why don't you look at doing cash secured puts out of the money, right? Because right now, for the out of the money 30 strike, for example, you're getting about $1.80 premium 3 weeks out. So your break even with ME 30 minus $1.80, it's 28.20, right? So if you're okay owning it at 28.20, then you sell a cash secured put here, and you pretty much just sit on it, wait for expiration, see if you get assigned. If you don't get assigned, you just made almost $2 in premium there. If you want to buy the stock at that point in time, and it's at 32, for example, you made $2, so your break even again is $30, right?
I had a question for you. I have a call option on that until I think February 26th. If I see the price go up this week, should I sell or should I hold it in anticipation that's going to go higher next week for the, what do you call it, earnings report?
That'll be your entirely your decision. Obviously, I would say manage your risk and whatever your exit strategy was when you enter the trade, that would be what you need to follow. So if you're okay, if you're planning on selling, for example, at 35 or at 40, then you want to exit whenever it hits those prices. Holding through earnings could be risky because you're going to have high IV prior to the event. After the event itself, IV will die down. So if you have out of the money contracts, they'll erode pretty fast in value because again, on the 26th, they'll report, I think, around this week right here, possibly even on the 12th, I believe. So if they report there, you're only going to have about 2 weeks expiration. So if, for example, you have 40 or 45 calls out of the money, then after the event itself, IV is going to get crushed and your premiums will be gone pretty fast, right? So, yeah.
Palantir has a report date of March 15th, unconfirmed.
March 15th, unconfirmed. Okay, interesting because the last report they had was on November 12th. So I'd figure that it would be within 3 months of that previous date. So you said March 13th?
15th.
15th. Okay, so yeah, that's almost 4 months away. Huh, interesting. So it'll probably be before that, I would imagine, because that would be almost 4 months from the previous report date, right? Either way, just keep an eye on the ER date. Make sure that you're privy to that and aware of it. And holding through earnings is risky. So whatever you hold through that event, make sure you're okay with losing it if you're holding long, short-term expiration contracts. If you're holding long-term expiration, by all means, hang on to it because it doesn't really matter too much. Maybe sell premium against it on the IV spike. But if you're holding, 2 weeks past, or if earnings are, for example, past this date, then in that case, you won't have the binary event prior to your expiration date. So that catalyst would be gone for an upside move. If it trades flat over the next two weeks and change, whatever you have, if you have out of the money contracts, they'll just gradually dwindle down to nothing, basically, right? So that's Palantir. For the week ahead, if you want to trade it for the week ahead short term, again, I don't like trading short term expiration dates, but I know some of you guys do. So some ideas would be to trade, for example, the at the money call spreads. So you would buy, for example, the 35 strike call and then sell perhaps the 40 strike call against that. And in this case, your debit would be $1.45 or so. Break even would be $36.45. Maximum profit would be $5 minus $1.45, which is $3.55. So you have over 2-to-1 risk reward, actually about 2.5 times risk reward, which is pretty good. And your maximum profit is above 40, right? So not a terrible way to play it. Alternatively, if you want to own the stock and you want to sell cash secured puts, for this coming week, you'd sell, 32 strike, for example, maybe even lower than that, 31 strike. Not a lot of premium, but again, it's only 5 days out, so not terrible. I prefer to trade longer term expirations, and as I mentioned with Virgin Galactic, if you're trading longer term, instead of buying the stock itself, you could perhaps instead buy the leaps contracts that are in the money, and you're paying, for example, $20 strike price for a year out. You're paying around $19 per contract. So you break even is 20 plus 19. It's $39. But then again, you do the same thing. I mentioned with Virgin Galactic. You go to like, you know, a month out and you sell the out of the money contract against it, right? So your break even is 39. So you're selling above that. For example, you might sell the 45 strike, right? Now you just reduce your debit down from 19 down to about 1730 or so, or 1720 or so, right? So you've already cut your debit down substantially, and your break-even price is now lower at 37, 20 or 30 roughly, right? So that's Palantir for the week ahead. Obviously, if you're bearish on it, you can trade the put spreads. Same kind of idea. Just, you know, obviously go to the at the money long put, and then short, you know, $5 out of the money. But keep in mind, if it dips down, for example, and you're in a put spread, or like last week, a prime example last week was Blackberry, right? If you bought the call spread I mentioned last Sunday, which was the 15-18 call spread, risk was like I think it was 50 cents to make 250, so it was 5-to-1 risk reward, right? When it popped to like to $28 a share, that call spread was almost entirely intrinsic, so it was trading at almost $3 overall. So at that point in time, you got to take profit. You don't hang on to it because of, think about it. If you go from risking 50 cents to make 250 to all of a sudden now your position's worth 290 to make 10 cents, right? Would you risk 290 to make 10 cents? No. Therefore, exit it, take your profit, even though it's not max profit. All you're giving up is $10, but you're locking in your gain, right? So if for example, you know, last week you didn't do that, you would have gone from max profit to max loss in the span of like 2 days, right? So same idea applies to anything you're trading short term. If you're trading short term, whenever the profit is there, take your profit. Don't try and ride it for the last 10 cents or 20 cents, whatever it is, because it's not worth it, right? If you wouldn't risk that money right then and there, you know, 280 risk to make 20 cents, then you should close your position out. You shouldn't keep it on, right? It's bad risk management. So, but let's go over a few more names because we're already an hour and 13 minutes in this talk right now. It's gone a bit longer than anticipated, but we'll go over a few more and then we'll end it. So next up, someone mentioned Oracle. I'm going to talk about Oracle, Twitter, Facebook as well. Actually, no, Oracle and Facebook actually. So ORCL. Let me pull up the chart. It's like where my chart go? Here it is. I haven't looked at this at all. I'm just looking at this for someone that mentioned it. So looking at probably support right around here, roughly around 60-ish on Oracle. And also, oh yeah, I didn't mention earnings this week, right? So earnings this week we have, one sec, where am I? Oh, yeah, here they are. Earnings this week right here. So we have this week, we have NXPI on Monday after close. Tuesday before open, we have Alibaba, Pfizer, UPS, Exxon, BP, Harley Davidson, Hog, right? After close, we have Amazon, Alphabet, Chipotle, EA, FireEye, Match.com, Amgen. Wednesday before open, you have Spotify, Biogen, Ligand. Actually, Ligand is I believe it's the second most shorted stock in the market right now. So keep an eye on that too. I don't trade it at all myself, but let's look at it right here. So Ligand, right? LGND. So again, actually, this is a crazy short squeeze candidate. This is crazy. So look at this right here. 65% short float, right? The number of shares outstanding is so small. This float is really small right here. So that could be I mean, it's already squeezed up from like 100 to 185, but this could squeeze much, much higher. Like it has potential for sure, right? Again,
Does it have options?
I can check right now, one sec. It's LGND. Let me see. LGND. Yep, it does. And they have only monthly OPEX. Liquidity is pretty crap. No volume, no open interest. But that being said, let's see. February 19th expiration. So if we were to squeeze, I mean, again, the risk here is that it's a binary event of earnings, right? So if they have a bad report, it could also drop down as well because the shorts may have some kind of thesis that it's a crap company. Again, I don't know anything about the company whatsoever. I'm just kind of looking at it from the earning report we just looked at, or the earnings calendar we looked at right there, right? But regardless, right? So back to the earning calendar again. So we have Ligand, which is a heavily shorted stock with low float as well. So keep an eye on that, LGND. Obviously, I don't know anything about it, so do your own research on that, obviously. And then Wednesday after close, you have PayPal, Qualcomm, eBay, Corvo as well, Grubhub, So PayPal, SQ actually moves a lot on PayPal's report. So keep an eye on that. That could be a nice corollary play or sympathy play, if you will, on PayPal, trading SQ instead of PayPal. I know the last report PayPal had, they went from 188 or so down to 175 the next day, and then they popped back up on a solid report. And actually SQ went from 180 on the same report, PayPal's went from 180 down to 168, and then they popped up to 200 the same week. So a nice big swing on SQ on PayPal's report, right? Thursday before open, you have Clorox, BMS over here, right? Merck. After hours, you have Pinterest, Snapchat, Ford, Peloton, Activision, Blizzard, Gilead Pharmaceuticals, Unity, Fortinet, GoPro, T-Mobile, and then Friday you have Regeneron, and that's pretty much it that I look at over here. Yeah, so pretty busy week again. Tuesday, Wednesday are the big ones. Amazon, Alphabet, PayPal, Qualcomm on Wednesday, and then you have Pinterest and Snapchat on Thursday as well, and also Peloton as well. So a lot of activity this week, right? Going back to the option chain that we were just discussing. So I was going to look at charts over here, right? So one sec. Oh, whoops, that was the chart right there on Oracle. Yeah. So someone mentioned to discuss Oracle, right? So Oracle supports at around 60-ish or so right here, which is the previous resistance point, right around 60. Again, keep in mind, I don't trade Oracle at all. I'm just looking at it from for you. On the longer term time frame, you have support at around 60, and then support around 55 over here, and then you have support at around whatever this low area, around 50 bucks or so. Looking at the option chain on it, let's see. So option chain on Oracle. So you have this week expected move of around like $2 in one direction. So upside is like 62, downside is 58. I don't know how you want to trade it. Obviously, if you want to trade off support, then perhaps wait to see the test at 60 area. If it doesn't, then or if it bounces rather, then that'd be a long signal. But if it breaks below that, you can go down to 55 or so, right? That's what I'm looking at for Oracle right now. What else do we have on the watch list right now? So we had, so Facebook, they had an interesting report, and they're very concerned about Apple's new OS updates, right? So Facebook could be a nice short, actually. Looking at Facebook's chart, where'd my chart go again? 1 second. Here it is. There it is. Okay. So here's Facebook over here. So you can see they fell down after the report, 257. I expect them to tap the 244 mark again to see if it tests support one more time. If it breaks through, then downside would be around 220, 230 area in the next few months. So again, I'm not a big fan of Facebook right now, just because if Apple does cut off their ability to track people, that will be a massive, massive hit to their business, because then targeted ads would be useless, right? So if I'm a vendor paying for ad space on Instagram or on Facebook, for example, on mobile, and I can't get information or analytics on who's opening my ads, how long they're actually viewing them, where they're coming from, it's like that, or the demographics or location, for example, then what am I paying for, right? It's useless. So that could be a huge, huge hit to Facebook longer term. And that might actually be a bit of a problem for them. It could serve as a benefit to Apple as well, right? Because if Apple gets in that game of selling ad space on iPhones, that could be another boost to Apple stock as well, right? So Apple had a phenomenal report last week. So Apple, Microsoft, and AMD, they all crushed it. And actually, I'm very bullish on Apple, Microsoft, and AMD. AMD actually tapped down. So before I move on, Facebook, again, I'm pretty bearish on this overall. I'd wait for IV to decline a little bit and see if it hovers in a certain range before you go into some put spreads, perhaps. But I do think it has potential to move down to 245 area pretty easily. But looking at AMD, so here's AMD's chart over here, right? So AMD had a solid report, and as you can see, they actually dropped on that report, and they're now tapping the lower end of this range right here, right? So the previous support area around 85-ish I want to see them bounce over here. And if they bounce, again, upside is around 100 or so, right? So you might see a nice bounce play in the next couple months. Again, you want to buy more time so you have more time for your overall thesis to play out. So if I were trading this, for example, I'd be buying for March expiration because February is too soon. It's only 3 weeks out. So March gives me, a month and a half. If it trades back up to 95 or so, whatever, for example, that could be a nice trade right there. But if it breaks below 85, I want to exit because now support would then be around 75, right? So again, you want to watch your levels and understand, that once a certain area breaks, you can easily pull back down to the next area of support prior to a bounce back up, right? That's AMD. Apple had a great report. They made over $1 billion in revenues in one quarter, which is incredibly insane. And they actually fell on the report after hitting all-time highs prior to that. I do expect they'll bounce around the 130 area, which was holding pretty strongly on Friday. And you can see them push back up to around 145, maybe even 150 in the next couple of months. Again, barring a huge market correction. If the market pulls back, then everything will pull back, namely Apple, Microsoft, Facebook, AMD, whatever. But the reason why I mentioned Facebook before is because, again, if you're long a bunch of names in your portfolio, let's say you're long Apple, Microsoft, Salesforce, you want to have some counterweights in the event that the market sells off. So in that case, you may want to have, a short on Facebook, for example, via put spreads. This way, if the market crashes or has a nice correction of 10%, and Facebook pulls back hard, you're winning on Facebook. You can pull your money out of Facebook put spreads and push it into Apple call spreads, for example, or Apple calls, for a year out, that kind of thing, right? So that's part of your portfolio strategy, or it should be part of your portfolio strategy overall, right? Next name I was mentioning, so Microsoft as well, right? Same idea. So they had a great report, hit all-time highs around 247.70, and they actually fell down after the report down to 230, bounced up to 240 again, and then Friday they fell down again, right? So again, this is why I said last week as well that waiting till after the actual earning event is the best way to trade it, because again, you're not paying high IV, you have all the information in hand now. Now I know that they had a phenomenal quarter and their guidance was good as well, also with Apple and AMD. So now I'm happy to buy longer term because I know that they have a fundamental reason for them to go up, right? So and you're also paying lower premiums now because the binary event is now gone. So trading Microsoft, AMD, Apple after the event proved to be a great idea. Instead of trading before the event, where if you bought calls or if you bought puts prior to the event, you would have pretty much lost because the expected moves on all three of those names were so great that you would have lost money on every one of them pretty much prior to the event, right? So that's those names right there. Let's look at one sec. What else do we have here on the list? I think there's ExxonMobil and one other name. Let me see. Oh yeah, NEO. So somebody mentioned NEO, right? So NEO's chart over here. Again, NEO over here, support 55 area, resistance around 65 area. Trading in a pretty nice low range right here. Again, you might see consolidate between here and basically here now for the next, who knows? I mean, it could be basically 2 months, right? So you might see it range bound for the next 2 months or so, consolidate in this range of $10, and it might not be bad to trade the range of 55 long, short 65 or so. Obviously, managing your risk. Not a terrible idea as well. And actually, he mentioned that XPEB had a recall on some of their cars too, so that could be a boon for NEO as well, right? For
NEO, sorry, Nick. NEO has a January sales release and how many cars they made in December for the quarter.
Okay, sweet. So that right there.
This next 10 days.
Okay, sweet. So the next 2 weeks then, that would be a nice catalyst for the upside. So for example, if you tap 55 area, I may be bullish on NEO on that catalyst right there alone, right? So let's look at NEO's option chain right here. So for one, the expected move on NEO this week right here. Let me see if we have it in the chain. I know Frank didn't do it. Okay, so I don't have it right there, but I can do it manually easily. So let's look at the option chain over here, right? So for this Friday, the expected move is around $6.70. Let's say 680, for example. So upside would be around 63.80. Downside would be around $50.20. So it could trade as low as basically 50 this week. Upside could be around 65. Again, if it held that 55 area, then I look for a bounce to around 65. And again, as he mentioned, if they have good sales numbers in their report, you're going to see it probably push to 65 again, possibly break through it, and then hit all-time highs again, right? So that might not be a bad catalyst. Keep in mind, IV is still pretty high right now, 104.7%. IV on the week is 101.1. HV is 80%. So you're going to want to use call spreads. So if you're trading call side for the same week, I prefer to go out at least a few weeks instead. Right. So you might look at, for example, trading the 60 calls. Oops, one sec. Let me close this. 60 calls and shorting the 70 calls, right? And this way you have 3 weeks of time on your position. You're risking $2.50, for example, to make a maximum profit of $7.50. So you have 3-to-1 risk reward, and your break even is $62.50, right? So not too bad overall, given that you have a fair amount of time on the position as well. If you wanted to reduce risk a little bit more, you could do even a butterfly call spread. So for example, you could go long the 80, sell 2 of the 70s over here, and now your debit goes from $2.50 down to $1.30 or so. So now you're risking about $1.30 or $1.35 to make a maximum profit of $8.65. So that's much more favorable asymmetry of risk. And then you want to see it stay below 70 pretty much for the duration of the next 3 weeks, right? If it's just below 70, you make almost max profit on the position. And what you could do, for example, if you bought let's say 2 contracts for $1.35 each or so, right, or $1.40 each, right? Then if it doubled in value, you could sell one of them because at that point you'd be removing all your risk. So you'd have no risk then to make maximum profit of $10 or $1,000 per contract, right? So just a little idea right there about butterfly call spreads on NEO. And the last one we're going to look at is XOM before we cut off, and maybe even look at SPY as well. Oh, actually, you know what? I want to look at VLDR before we got moved on as well, right? So VLDR is actually in a primo setup right now. So it's been forming these incrementally higher lows, like not very high above the previous lows, but it has been doing so. And right now it's tapping the lower end of this little range right here of 21 to around 25 or 26 area, right? So keep an eye over here. I actually like the stock here, like buying the equity itself and selling covered calls out of the money on a monthly basis because of the premiums, very high premiums as well, right? So not a bad idea. If you want to own the stock at a lower price, keep in mind VLDR is Velodyne, which does LiDAR for autonomous driving, right? So VLDR, you could, for example, sell cash secured puts. And again, they only have monthly OPEX, so you're kind of limited in your ability to trade this, right? But for example, you could sell cash secured puts at the 20 strike for 3 weeks out, and you're getting about $1.65. And I'm assuming they have earnings in between now and then, given the high premiums there. Earnings are past that. They're February 25th. So that's actually not a bad play. If you don't mind owning it at 20 minus $1.65, you own it effectively at $18.35, right? Again, do your own research, understand what they do as a company, understand why you're investing in them, manage your risk well. Again, everything I'm discussing here is purely for educational purposes only, right? And then lastly, we're going to talk about XOM because someone else asked about that too. So they report this week too, XOM. So longer term time frame, 1-year chart. Again, you want to see it try and break above that 50 mark and hang above it, right? We saw it tap that and then fall down, so that's pretty bearish. Support is right around previous highs of around 42, so not too far from there. But I don't really see a thesis here as to going long on it. If you want to go long and own the stock for the dividend, that's not bad because right now they're currently paying a dividend of 7.8% or $3.48 per share per year. So owning the stock itself plus selling covered calls on it is not a bad idea if you want to create some income for yourself on a pretty conservative company. But otherwise, looking at SPY again, just to finish off, I mentioned last week I expected a nice big pullback down to the 350 area. I think we do get that before March expiration. And I mentioned that those combo spreads last week. I mentioned the March expiration. Here it is right here. So I'll just build it again so you guys can see. Last week it was trading at $1. I think it was $1.40, I believe, to make maximum 860 profit. Right now you can see the same position right now is trading at, so it was long 380, short 370, short 350, and then long 340. It's called the combo spread right here, right? So you can see that already it's trading at midpoint right now of about $2 and about $2.10 roughly, right? So already in 1 week it's up about 50%, right? So not too bad overall. Again, if you got to target the middle price for expiration. So I think it'll be around 350-ish come March 19th. That's why I targeted this area right here, right? So
one last point, Nick.
yeah.
So with having a bearish sentiment on the market overall, precious metals are a target. I'm seeing a lot of sentiment towards SLV, AG. I'm seeing that kind of pushed across the board.
Oh, you mean silver?
Yes.
Oh yes. Oh yes. So you actually asked about SLV, right? So let me analyze SLV as well, right? One sec. So SLV, where's the chart? Here it is. Last one before we do some Q&A, I guess, before we drop off, right? So again, right now as I speak, futures on silver are trading up. Let me see what they're at right now. They're up. Let me see. They're up right now. Wow, they're up 6.5% right now. So up to 29 or so. So you're seeing on. Let me get rid of this screen right here so I can see. So right now, silver SLV should open up around 29 over roughly over here, right? So somewhere around here, right? So that would be a new. I think is it all-time high? Let me see the chart.
I don't think all time.
No. It would be a new year high, right? So yeah, that could be a bullish play as well. I've been reading about it on Wall Street Bets, it's like that. Again, if you have physical silver or physical gold, it's not a bad play to have, longer term as a bit of like a quasi hedge. Like 10% of your portfolio in metals isn't a bad idea. But right here, with everyone piling into it, and also with the implied volatility, I assume it's pretty high because fund manager mentioned to me on Thursday to go long silver as well. Yeah, it's super high right now. So Ivy is very high right now, 68.5%. Like the monthly OPEX out of the money contracts are trading at like 67 cents. So you're getting a fair amount of premium for you to cover calls on SLV, but you may be a sign if it keeps on bursting the upside, right? There's that too. Oh, there's also one more, which was XRT, the retail ETF, right? That one is it has GameStop as the largest holding in it right now. And here's the chart. It's pretty insane. You can see it's had a massive run because of GameStop the last few weeks. And so it's pretty much gone from like 65-ish, hit a high of 100 on Thursday. So it's up 58% in like the last few weeks or so. So pretty insane because this ETF is full of companies that are bleeding cash right now and that are pretty poor in quality. So
Pardon? Look at the retrace on it.
Yeah, I know.
Went from 100 to like 80.
Yeah, massive move to the downside right there. It filled that gap nicely right there. So just some ideas there, guys. I'm gonna cut the recording here. I'll stay on for another 10 minutes or so for the Q&A session. But if you guys enjoyed the video, please like, subscribe, share with someone else. Appreciate that. If you have any questions or comments, drop them below. And I'm gonna cut the recording right over